Hey there, fellow market junkies. Today we're diving headfirst into the wild world of the Micro E-mini S&P 500 futures, specifically the ES contract. We're talking about the 4-hour candlestick chart, folks. This time frame gives us a fantastic look at the market's short-term swings. And believe me, there have been some wild swings lately. As I'm writing this on March 24, 2025, the ES is sitting at a critical juncture. The index closed at 5,754.25 yesterday, and we need to figure out where it's headed next. Is this a chance to buy low? Or are we staring down the barrel of further losses? Let's break it down, Kramer style. Now let's talk trends. From November 2024 to mid-January 2025, the ES was on fire. We saw a beautiful uptrend with higher highs and higher lows. It was a bull's paradise. The bulls managed to push the index all the way up to 6,200. That's some serious momentum, folks. But hold your horses, because things took a turn in mid-January. That's when we saw a classic change of character, or chach. The market shifted from bullish to bearish, and the downtrend began. Lower highs and lower lows became the new normal. Since then, the bears have been in control, dragging the index down to its current level. It's been a wild ride, and we need to be prepared for anything. Alright, let's talk about the battlefield. Every good trader knows that support and resistance levels are crucial. They act like walls and floors, dictating where the price might bounce or break through. In the case of the ES, we've got some key levels to watch. On the downside, we have support at 5,700 to 5,750. This zone represents a recent low and a potential area where buyers might step in. If the bears break through this level, we could see a further decline towards 5,650, which was a previous area of consolidation. On the upside, resistance is looming large at 5,850 to 5,900. This zone represents a previous lower high and what we call the equilibrium level. It's like a magnet pulling the price towards it. If the bulls can muster enough strength to break through this resistance, we could see a move back towards 6,000, a key psychological level, and a previous area of consolidation. Section 4. Decoding the market's whispers, smart money concepts in action. Now here's where things get really interesting. We're going to delve into the minds of the smart money, those institutional players who move billions and really drive the market. One of their favorite tricks is the break of structure, or BOS. It's exactly what it sounds like. A decisive break above or below a key level, signaling a potential shift in momentum. Looking at the ES chart, we can see several BOS moves. The initial uptrend was confirmed by a BOS above a previous high. Then, the downtrend was confirmed by a series of BOS moves below key support levels. These moves tell us that the smart money is actively trading this market, and we need to pay attention to their footprints. Remember that chach we talked about earlier? Well, that's another smart money concept. It tells us that the market's character has changed, and a potential trend reversal is in play. We've seen multiple chach signals on the ES chart, with the most recent ones favoring the bears. Section 5. To bull or to bear. Analyzing potential trading scenarios. Okay folks, time to put on our trading hats. We've got the technical analysis down, and now we need to decide how to play this market. The big question is, bullish reversal or bearish continuation? The bullish case rests on the fact that the ES is currently trading in what we call the discount zone. This means that the price is below the equilibrium level, suggesting that it might be undervalued. Furthermore, the recent sharp decline could be a sign of capitulation, where the last of the weak hands are selling, potentially setting the stage for a bounce. However, the bearish case is equally compelling. The downtrend is well established, and the bears are clearly in control. The economic backdrop is uncertain, with the escalating trade war and mixed economic data weighing on sentiment. If the bears break through the 5,700 to 5,750 support zone, it could trigger a further decline. Section 6. The Kramer call, my recommended trading strategy. So what's a trader to do? In this market, I'm leaning towards the bullish reversal. I believe the risk-reward favors buying the dip in the discount zone. We've got a potential for a quick move to the upside, while our downside risk is limited by the nearby support level. Here's the game plan. Entry point. Buy around ES 5,755. just above the current price. Stop loss. Place your stop loss below the recent low at ES 5,690. Target. Aim for a move back to the equilibrium zone at ES 5,875. This trade offers a solid risk-reward ratio of 1.85 to 1. That means for every dollar you risk, you have the potential to make $1.85 in profit. Remember, trading is all about managing risk and maximizing profit potential. For those of you who are a little more risk-averse, you could wait for a confirmation signal, such as a bullish candlestick pattern or a break above a key resistance level, before entering the trade. Section 7. The bigger picture market context and potential risks. Before you rush out and hit that buy button, it's crucial to consider the broader market context. The S&P 500 has been on a wild ride lately, and the ES is no exception. The ongoing trade war, mixed economic data, and the Federal Reserve's monetary policy decisions are all creating uncertainty in the market. Remember folks, trading is risky business. Never invest more than you can afford to lose. Do your own research, manage your risk, and never ever fall in love with a stock.